Alan Kohler here, and I'm talking to Glenn Corrie, the CEO and Managing Director of Hazer Group. He took over from Jeff Ward last October, and I interviewed Jeff last August. And I thought it'd be a good idea to catch up with Glenn to just see how he's seen the company. And also, they've just announced a big deal with a couple of Japanese companies to build a plant in Japan that would add to their demonstration plant in Perth and the plant that they're working on in Vancouver. So Hazer has got technology to make hydrogen and graphite from methane, and they're looking to disrupt the existing hydrogen market and to make hydrogen for the future hydrogen market that's obviously there. And I think part of the reason I'm interested in Hazer and interviewing them a couple of times in reasonably quick succession is because I think hydrogen is clearly a big future industry, and this is one of the few ways of getting in some exposure to it in Australia. I'm not saying that you definitely should invest in Hazer. I don't know. It's a risky proposition, and it's going to take a while to start generating cash. But they seem to have a good technology. It seems to be innovative. They've got patents for it, and they are starting to, and they expect soon to have a big demonstration plant operating in WA, which could attract some attention. So look, I think it's worth paying some attention to. Here's Glenn Corrie, the CEO and Managing Director of Hazer Group. Well, Glenn, you've recently taken over and now just announced a deal. Describe the deal that's with Japanese companies.
Thanks, Alan. Yeah, look, the deal, from our perspective, it's a strategic deal for everybody involved, and of course, very transformational for Hazer, which really further validates our technology in a market, Japan, that we believe is an ideal fit for the company. And as I've said in our announcement, it firmly positions us as a really serious climate technology that's coming up the scale real quick, and is there to support and accelerate global decarbonisation.
Yeah. But so you're going to build a plant in Japan? Is that the idea?
Yeah. So the idea is that we're going to work for the next 6 to 12 months, effectively developing what we're calling a project development plan, which aims to effectively build a Hazer technology plant, a hydrogen and graphite carbon production facility in Nagoya region. Initial phase will be up to 10,000 tonnes per annum, and then all going to plan will potentially increase that over 50,000, potentially up to 100,000 tonnes per annum. So a really large commercial scale Hazer facility, which is going to be effectively deployed in the Chubu electric power region to effectively support their decarbonisation of their power network.
Right. So and the company is Chubu Electric Power Company, right?
Yeah. So there's two companies involved. The first one is Chubu Electric Power, and the second one is Chiyoda Corporation. Both of them, Chiyoda's one of the world's largest industrial groups, and Chiyoda, who will be familiar to many in Australia because they are one of Australia's largest buyers of LNG. In fact, they import, I think, roughly around 15% of Japan's total LNG importation. So fairly large energy giant as well, and both of them are really serious about their decarbonisation strategies in their portfolios.
And so who's going to own the plant?
Well, the plant, Chubu Electric and Chiyoda.
Right.
It'll be a plant for their industry. We'll of course bring. Go ahead.
No, just so you'll be licensing your technology to them. Is that how it'll work?
Yep. Yeah. Our role in the venture will be two things. It's to license the technology to them as well as supply the catalyst, which is a key component of our process. And that is the iron ore that we use in the process itself.
Probably better just remind our listeners what your process is and where you get the methane from.
Yeah, no, I will actually step back and talk about the technology, if that's okay. Well, Alan, we are a methane pyrolysis technology, so it's a technology that's been around for over a century, so well established. Essentially, it takes LNG or natural gas or methane, and effectively at a temperature of somewhere around 800 to 900 degrees Celsius, it decomposes methane, which is CH4, into its raw elements of pure hydrogen and graphitic carbon. Now, our X factors, as I like to explain them, are twofold. We use iron ore as a catalyst to accelerate and lower the process temperature. And secondly, we have a graphitic carbon product output alongside of the hydrogen. So normal methane pyrolysis technologies run at temperatures far exceeding 2000 degrees, and they have a carbon black product. So with graphitic carbon, we're able to serve a much broader application in industry, all the way from lithium-ion batteries, potentially down to large-scale, low-grade battery technology, water purification, replacement for coke and coal in the steel making process in the blast furnace. So a much broader application, which we think will attract a premium in the long run. So that's generally the process that we employ. We've been at this now for 15 years. We have scaled up very successfully our technology over the last 10 to 12 years. And we're on our 6th scale up today with our project in Canada. So Japan will represent the 7th. And we are at that tipping point now of commercialization.
And where will you commercialize first, do you think? Where do you think you'll be selling the first hydrogen from your process?
Well, I think the first place we'll see revenue coming into the company is through our Suncor and Fortis facility in Canada. We struck a transaction with both of those companies early part of last year to develop a plant in Vancouver, British Columbia. And we will be essentially blending hydrogen into the Vancouver pipeline network. So there will be effectively revenue flowing from that project when it starts up in late 2025.
Right. Okay. So that's 2025. When do you think the Japanese project will start to generate cash?
At the moment, well, yeah. At the moment, we essentially work on about a 2 to 3 year period for feasibility studies, engineering, and then design, construction, and startup. We have it currently on our initial plan in 2027, 2028, and that's consistent with what we've just said to the market. And if we can accelerate that, even better. One of the benefits of the project is that we've been working with Chiyoda Corp now for a number of years, 2020 actually, in looking at some conceptual engineering studies to support a Hazer facility in Japan. So we're already out of the blocks on that project with a bunch of pre-work and conceptual design work and engineering work to support that project. So we'll be looking for every angle to accelerate it to the extent possible.
Could you, the work, presumably a lot of the work you're doing both in Japan and in Canada and with Chiyoda is around about the pricing of hydrogen, the cost and the pricing and what the profit's going to be and so on. Can you just take us through the pricing, how it's going to work and what sort of price of hydrogen you need and how likely that is? Yeah,
well, the first point to make is that the hydrogen market, actually, I'll even step further back. I mean, the hydrogen market today, Alan, is actually very large. And what many people don't appreciate is that it is 100 million tons per annum today, the market. So and I like to tell people that's over a quarter of the LNG market in its scale. So it's a large market. In value terms, hydrogen market versus the LNG market, actually the hydrogen market's valued even higher. It's about $175 billion market relative to $150 billion market. So it's large and it's more valuable. Now, but the challenge is it's not a liquid market, as you may appreciate. So typically speaking, hydrogen is produced today through a process called steam methane reforming, which has been around for a very long time. Now, the downside of steam methane reforming, which is responsible for around 95% of the hydrogen market today, for every kilogram of hydrogen that's produced through SMR or steam methane reforming, there is 11 kilograms of CO2. So whilst it actually doesn't solve the climate problem, it actually creates one. So our disruption is to replace steam methane reforming, which is disruptive today. Now, in terms of the market itself, it is a captive market.
Can I just
a lot of
interrupt
these.
Glenn, can I just interrupt
Yep.
that market, the 100 million tons or whatever it is for hydrogen that's currently being sold? What's it being used for? Who's buying it? Tell us how the market. What is the market for hydrogen? Because it's not for cars.
Yeah,
right?
well, the market, interesting enough, no, it's definitely not for mobility yet, but it will be. The market today is generally steel making. It is generally cement making, where you really need high temperatures and you can't achieve that through power. Petrochemicals as a feedstock for fertilizer and ammonia. It is also used in refining to desulfurize crude oil. So there's a really wide ranging application of hydrogen today that's being used in the industry. Now, the challenge for industry is that at these very high temperatures, it's very difficult to electrify them. So you need hydrogen to effectively get temperatures up to where they need to be. That's what we call hard to abate sectors. And all of these sectors, petrochemicals, refining, ammonia, fertilizer, the steel making, cement making industries, they all require hydrogen to effectively run their processes. And they all produce that through typically steam methane reforming today worldwide. And there's thousands of these plants operating. And for every one of them, as I said, there's for 1 kilogram of hydrogen you produce, there's 9 to 11 kilograms of CO2.
And what's the current price of hydrogen?
Well, like I said, it's not liquid, so to unravel that is difficult. What basically the industry works on today is the cost of supply, and most hydrogen prices, if you like, are transfer pricing linked to feedstock prices, which are natural gas or LNG or methane. So that's typically so the way to think about the economics and the pricing model of this is through a margin relative to your input parameter or input cost of gas as your feedstock. So for example, in the US, where you've got Henry Hub as the pricing marker, or North America or Canada, you'll have feedstock there at $3 to $5 per MMBTU, a molecule. In Asia and parts of Europe, you'll probably see LNG or gas prices go up to $8, maybe $10 an MMBTU. Yeah.
Okay, right. So two questions for you then with Hazer. Is your methane cheaper than what? Is your hydrogen, I beg your pardon, cheaper than what comes out of steam methane reforming? And what's your CO2 output?
Footprint, yeah, it's a very good question. So in terms of our cost, and we have a slide that we have recently put into one of our investor decks, which tries to articulate the differences between the three main hydrogen technologies today. Green hydrogen, which is commonly referred to as electrolysis. There is grey hydrogen, which is steam methane reforming, as I said, 95% of the market. And there's turquoise, which is us, Hazer. Green hydrogen, of course, is electrolysis, just pure thermodynamics, Alan. The ability to split and decompose water, H2O, into its raw elements of water and oxygen, or hydrogen and oxygen, is 7 times harder than doing the same process with methane, splitting it into carbon and hydrogen. So just pure thermodynamics, the Hazer process is 6 to 7 times lower energy intensity, which translates into a lower cost. So relative to electrolysis and green hydrogen, we're going to be much more cost competitive. Relative to steam methane reforming, steam methane reforming it's a very well-established process. It's currently running industry-wide today at around $2 to $3 a kilogram of hydrogen. Now, these are all US dollar unit costs. But in the long run, because of the high CO2 footprint, steam methane reforming will need to transform into what they call blue hydrogen, which is abating and sequestering or re-injecting the CO2 into a subsurface reservoir to essentially dispose of the CO2, because long run, of course, you can't deal with all the CO2 emissions. So that, on our numbers, takes the steam methane reforming process from around $3 to to $4, possibly $4.50 a unit cost. Hazer, on our numbers in our business plan, at a 50,000 tonne per annum plant, ranges between potentially $3 and $4, depending on your input assumptions. That will be driven by the value that we ascribe to the graphite. Now, if you say, well, okay, the graphite market is not well established today, and we're not able to sell large volumes into the market, then we'll be leaning towards that $4 unit cost. If we attract, in the range of, a couple of $100 a ton for graphite, then we'll see our overall benefit and unit cost come down to, converging towards $3 a kilogram.
Right. So $3 assumes that you're selling the graphite for a decent price.
That's right. Yeah.
A lot of the literature on the subject, particularly from the government, talks about that the hydrogen price needs to be sub $2 in order for the whole thing to be viable, particularly for mobility. Can you ever get your price down below $2?
I think in the long run, yeah. I think the industry's fairly early stage, so I think there's a we don't factor into our numbers the learning curve yet. I mean, we also don't factor into account the growth in the graphite market. Both of those could substantially turn the needle. These are not complex plants, so there's definitely a capex learning curve that we've got to apply, working alongside Chiyoda, working alongside Suncor and other big engineering groups like Wood and Hatch. We're confident that our learning curve is going to be, going to benefit us in the long run. On the feedstock side, I think natural gas prices are always going to bounce around depending on what jurisdictions you are. But I think the real value kicker here, to be fair, is the graphite. We've been partnering now with Mitsui, the big trading group out of Japan, for a couple of months, and they have been exploring the potential market for our graphite. And the initial results from that study and that work are very exciting. One of the ones that I wanted to highlight is that we have got quite a bit of attention from the Asian steelmakers who see Hazer graphite as a potential replacement for the coking coal that's used in the blast furnace. Now, that's a much bigger industry than the lithium-ion battery industry. And of course, steel making and cement making is, I think, responsible for maybe 20% of global CO2 emissions. So it's a big problem, a big market that needs a decarbonisation solution yesterday. And I can see, just based on the initial work that's been done with Mitsui, that we've got a lot more running room in the graphite market, the Hazer graphite market, yet to play out. So, I don't want to, take too many guesses on numbers, but I could easily see the graphite market, edging above $500 a ton in the long run for Hazer graphite, possibly even higher.
What would $500 a ton do to your cost of hydrogen?
Well, very simplistically, very, very crudely, and it's much bigger than this. But if you say, well, $500 a ton divided by 1,000 is 50 cents a kilogram, that could be the net benefit. Now, bearing in mind that for every kilogram of hydrogen we produce, we have 3.8 kilograms of graphite. So, you almost need to multiply that by 3. So I can see a pathway to 2. Alan, we're not there yet. Of course, we've got work to be done, but we're quickly coming up the technology curve. And I think as we start to deploy plants, come up the learning curve, I think we'll start to see our cost be very, very competitive in the market. Is it worth talking about our CDP, or did you?
What's
because
the
we've
CDP?
got our commercial demonstration plant. Yeah.
Yeah. Well, so where is this? Is the one in Vancouver?
No. So we've got our commercial demonstration plant about to commence operations this year. It is the 5th scale up of our technology, so it takes us to a very advanced technology readiness level. It is 100 tons per annum, and it is the 30 times scale up on our pilot project that we did between 2017 and 2020.
And where is it?
We will. It's in the Perth metropolitan area, just south of Perth. So it's close by. We have more or less completed the construction of it. We had a few speed humps last year due to supply chains. We're waiting on two pieces of equipment, the heat exchanger and our first generation reactor, which should arrive in the next couple of months. So we're very excited about bringing that project online. It's been work in progress now for the last couple of years, and it really just demonstrates and showcases our technology at an industrial and commercial scale on a continuous basis, which is the most important thing as you start to roll it out commercially.
And the plan, your business plan, involves just licensing your technology multiple times. Is that correct?
Yeah, that's correct. We take a capex light approach to our business, which does a few things for us. Importantly, it enables early free cash flow for us. So we're deploying the typical licensing arrangement to a technology, as you'll see in the industry. Our licensing structure is a combination of license fees and royalties on outputs. And we like to think of ourselves as one technology that serves three markets, and that's nice diversification. We have a hydrogen market to serve, we have a graphite and graphitic carbon market to serve, and the one that I think is a real sleeper in terms of value is that we have the whole decarbonisation carbon offset market to serve. Using Hazer technology will save the user costs because they don't need to buy and purchase carbon credits. So there's three markets, one technology, and that's what drives our value. So capex light, early free cash flow, and serving three markets. Yeah.
Does your process produce zero carbon dioxide or some?
Yeah, so I should have got to that. So our absolute process internally, scope 1 emissions is zero. We don't refer to ourselves as zero emissions because our scope 2 emissions relies on is a direct implication of the power grid that's being used. So in Australia, of course, we'll have slightly higher carbon intensity relative to, say, Canada. But to give you an idea, our carbon intensity for our project in Canada is, I think, around 0.5 to 0.65
This is because
kilograms of CO2.
This is because of the electricity you're buying is hydro.
Yeah, so the electricity, the energy mix in Canada is a combination of hydro and gas, and so it's a lower carbon intensity. In Australia, of course, that's going to be slightly higher because it's mostly gas and coal. But so it'll be driven by the power grid, but that's the scope 2 emissions. And of course, as grid power comes, cleans up, that's going to reduce. That said, of course, we can always plug ourselves into a renewable power grid. There's nothing stopping us from doing that either. So we can be a pure net zero process. Now, at our CDP in Perth, we are actually using the Water Corp's biomethane and wastewater gas. So we are actually there achieving net zero for our process. Now, that could be a possible business model for us on a smaller scale, addressing the large carbon or methane footprint of wastewater treatment plants. But that brings our process, at least in Perth, down to zero, proves that we can do it using methane and wastewater gas. And of course, with that, we also attracted Australian government funding through ARENA to the tune of, I think, just shy of $10 million. And we just recently unlocked another tranche of that, which is $3 million.
So is your long-term plan to just disrupt steam methane reforming, that process, that industry that exists, and to basically take that industry to some extent, or is it to get a share of the future hydrogen that's going to be made for mobility and whatever else using electrolysis, so that it won't entirely be electrolysis, or is it a bit of both?
Yeah, look at that. No, look, there's a market for all of these technologies today, but I think where we are able to accelerate our deployment is today, because we can disrupt steam methane reforming, which is most of the market. And that said, there's a future application in the short term in terms of mobility and other applications. So we are something that can be deployed today. That's the real benefit of Hazer relative to potentially some of the other technologies and processes and projects that are coming up the curve. And that's what's attracting the attention from a lot of the users. So our deal in Japan is because we are something that can be deployed today to fix a problem that needed to be fixed yesterday. And that's the excitement of Hazer relative to others. Now, we are very understanding that the market is large and there's a place for everybody here. But, from our perspective, it's getting the first mover advantage, getting on the ground, getting the, initial phase of these projects designed and built. And then from there, we can scale up. My vision for this company is that we essentially contribute to global decarbonization in industry and provide that, that future generation with a much cleaner planet. So, our ability to be on the ground today to develop projects that we can scale up into the future and essentially build and operate alongside partners, projects that will be larger scale, I think is an advantage for Hazer today.
We'll have to leave it there, but it's been really interesting talking to you, Glenn. Thanks very much.
Thanks, Alan.
That was Glenn Corrie, the CEO and Managing Director of Hazer Group.